Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Friday. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage related. If you find this content helpful, like and subscribe. So a few weeks ago, Fed Chairman Powell made a comment that the economy has given us several head fakes. And by that, he means that we've seen some data and some trends to where the Fed is in a position to cut rates, and then those trends have reversed and we're looking at higher rates for longer. This week felt like at least a partial head fake. On Tuesday and Wednesday, it seemed like things were getting a lot better. Rates were improving due to multiple jobs-related reports. And then today, Friday, you had two reports. You had non-farm payroll come in higher than expected, which was not what the mortgage market wanted to see. And most importantly was unemployment. And if you saw my video last week, I mentioned that if unemployment goes up significantly, that could be a signal that it's going to keep going up more steadily. So I thought if unemployment went up to 4.1 or higher, then the Fed might feel the need to cut rates a lot sooner than they would like. And all along, the Fed has been saying they want to cut rates when inflation goes down to 2%. But I thought this might preempt that. Now, not only did unemployment not go up, it actually went down. It didn't even stay flat. It went down to 3.7% versus 3.9% the month before. So not surprisingly, rates have taken a little bit of a turn because of that news. And now the likelihood of a Fed rate cut in March has gone down quite a bit. And frankly, I still think the market is even a little overly optimistic. I think based on this information, the likelihood of a recession is very low. And based on that, the Fed is going to wait until inflation gets down to 2%, as they've said all along, and that's going to take a lot longer. This ties in nicely to next week, where the big potential market mover is on Tuesday, where we'll get CPI for November, the first inflation report of the month, which is typically the biggest market mover. And as has been the case for the past 4 or 5 months, my big focus will be on the shelter component of CPI. We saw a nice decrease last month, but that has to continue or ideally get steeper in the next few months if we want to see a Fed rate cut, I'd say by the middle of next year. That's really the earliest I could see a rate cut now, unless unemployment takes a radically different turn. That's what it's going to take, is shelter coming down significantly, and with it, overall inflation should come down to that 2% mark. The other big thing next week is the Fed's rate decision. That'll be on Wednesday. Everyone knows the Fed is going to maintain rates, but the comments from Jerome Powell afterwards could be a market mover. If he's talking in a way that is signaling rate cuts in the near future, that could be a good thing for rates. If he's saying we're going to look at the data, we're going to keep the rate flat for the foreseeable future, and if he really is harping on that 2% overall inflation metric, I could see that being taken as a negative and rates getting worse. So as always, if you have any questions or comments, shoot them below, or you can call or text me on my cell phone. But thanks for tuning in this week, and I will see you next time.